According to a study by S&P Global, 88% of active large cap funds failed to beat the S&P 500 over the last 15 years as of the end of 2023. Now remember, these actively managed funds have dozens or hundreds of analysts working full-time trying to beat the market, and only 12% of them did it in the last 15 years. Obviously, the odds of being a successful stock picker are against the average investor.
All right, boys, I just got destroyed day trading.
I had negative $60,000 in the bank account because I lost it all trading options and stocks.
So I basically lost everything that we had built up to, like 7K in profit. We lost it all.
But this got me thinking, what if we use artificial intelligence, which is the greatest technological innovation of all time, to not necessarily pick the stocks for us, but to help us understand how to pick those stocks better? So off I went to talk to AI about it. Good morning, AI. What are the most important things to analyze when trying to buy a stock that will deliver positive returns?
When considering whether to buy a stock, it's crucial to analyze various financial metrics to assess its potential value and risk. In addition, there are many non-technical factors to consider as well. I can make an extensive list here, or I can summarize things. What would you prefer?
Now, it sounded to me that if I let AI go on as long as possible, this video would probably be about an hour long, and that definitely wasn't going to work. So instead, I asked, can you summarize the 8 most important factors to consider, including both technical and non-technical factors? Now, I should mention for those who don't know, technical factors means looking at statistics and data for information, and non-technical factors mean looking at the company as a whole and understanding how they operate.
Of course, let's alternate between non-technical and technical factors to give a more holistic approach when analyzing stocks. Let's begin with the first factor, which is 1. Industry trends and news. Understanding the broader industry context is essential. Keep informed about industry trends, news, and developments that could impact the company. This helps in assessing the potential growth or risks associated with the sector in which the company operates.
So this is pretty clear. So as an example, if you're looking at investing in a company like Tesla, you don't just want to look at EV cars and EV companies surrounding Tesla. You want to look at lithium companies as well, so that you can understand the entire market as a whole. Now, I didn't have any more questions there, so I asked AI to continue.
2. Next is price to earnings, PE ratio. The PE ratio is a widely used metric that helps investors determine the market value of a stock compared to the company's earnings. It provides insight into whether a stock is overvalued or undervalued relative to its earnings. A lower PE ratio might suggest a stock is undervalued, especially when compared to industry peers.
So when investing myself, I always pay attention to the price to earnings ratio. But there was a question that I had there, and that is, what is a good price to earnings ratio?
A good PE ratio is often determined by comparing it to market benchmarks, such as the average PE ratio of the S&P 500, which typically ranges from 20 to 25. Stocks with PE ratios significantly above this range might be considered overvalued unless justified by strong growth expectations. However, it's essential to consider the industry context, as different sectors have varying average PE ratios due to differing growth prospects and risk profiles. Additionally, historical averages of a company's PE ratio can provide insight into its valuation relative to past performance.
See, that's what I was looking for. While it definitely seems like it depends on the industry, I guess you could say average or typical PE ratio is right around 20 to 25. And I do want to mention too, a PE ratio itself has never stopped me from buying a stock, but it is definitely something that you should consider when looking at all other variables. That all made sense. So from here, I told AI to move on to the next point.
3. Company management and leadership. Investors should focus on the quality and track record of a company's management team, as they can significantly influence its performance. Strong leadership often correlates with effective strategic decision-making and operational efficiency.
So let's go back to Tesla here. When people are investing in Tesla, they're not just investing in Tesla as the company, right? They're investing in its founder, which in this case is Elon Musk. So love him or hate him, the guy has built some insanely profitable and successful companies. And that's one of the things that anybody who has ever invested in Tesla or considered Tesla is looking at and considering before they actually make the investment. Now, I didn't have questions on this. It's clearly an important factor to consider. So I asked AI to continue on.
4. Price earnings to growth, PEG, ratio. The PEG ratio enhances the PE ratio by factoring in the company's expected earnings growth. This metric helps investors assess whether a stock's price is justified by its growth potential. A PEG ratio below 1 is often considered a sign that the stock is undervalued relative to its growth prospects, and the average PEG ratio for the S&P 500 currently is 1.26.
Now, it makes sense to include expected earnings growth because I found that analyst estimates are usually on target and good companies will either meet or exceed them. So in my eyes, this is basically including future growth potential into your decision on whether or not you want to invest in a company. So I could see why you'd want to include that. I love that AI pointed that one out, but let's move on to the next one.
5. Brand value and market position. A company's brand value and its position in the market can affect its competitive advantage. Companies with strong brand recognition and a solid market position are often better equipped to withstand economic downturns and competitive pressures.
So this one makes a lot of sense. Most everyday investors want to invest in big companies because those companies have built up a lot of trust and reputation over the course of time, and they know that they can actually trust them with their money. So oftentimes, the best stock picks are the smaller companies that are growing really, really fast that most people aren't even aware of. Now, finding those companies in the early days is definitely not easy to do, but paying attention to the news and hearing when, these smaller companies get a ton of funding, that is something that you can basically pay attention to. And when you see that, it might be a really good time to consider investing if you're able to do so. And just remember, all these really big companies that you know of today, they all started as these small rinky-dink companies. Apple, Google, Nvidia, all these companies, they're all starting from somewhere. So keep that in mind that smaller companies aren't necessarily a bad thing, but picking the right smaller companies to be those really, really good ones, that's definitely not easy. That said, let's move on to AI's next recommendation.
6. Next, we have free cash flow, or FCF. Free cash flow represents the cash a company generates after accounting for capital expenditures. It is a crucial indicator of a company's financial health and its ability to generate cash to fund operations, pay dividends, or reinvest in growth.
So it's clear why free cash flow would be a really important metric to pay attention to. In business, money is power, and free cash flow is a very good measure of that. You want to know how much money the company is taking in after its major expenses, and you want to know how much they have for, things like future investments, stock buybacks, things like that. That all said, like all the factors that I mentioned in this video, I don't think that there's just one that can give you a real clear picture of how a company's doing. For instance, in Q1 of 2024, Tesla had a free cash flow of negative $2.53 billion. But then in Q2, it had a positive $1.34 billion. I think the key to this is to understand where the company is investing, to understand why the free cash flow is increasing or decreasing. Now let's move on to the last non-technical factor.
7. Economic and political environment. From a non-technical aspect, this is the last factor I'd recommend analyzing. Consider factors like interest rates, inflation, and regulatory changes. These can have significant impacts on a company's operations and profitability.
Now, this is one of the things that I've always relied heavily on when picking stocks. So, for example, is the government pushing green technology and offering tax rebates for those who purchase them? For EV cars and solar panels, this is exactly what's been happening all the way since 2005. So going back to our Tesla example, you can see obviously why those particular incentives would be really, really beneficial to a company that creates EV cars and creates solar panels. Let's finish up with the last non-technical factor.
8. Lastly, I'd suggest you focus on the debt-to-equity, DE, ratio. The DE ratio measures a company's financial leverage by comparing its total liabilities to shareholder equity. A high DE ratio may indicate higher financial risk as the company relies more on debt financing. It's important to consider this ratio in the context of the industry and economic conditions.
I think the debt to equity ratio makes sense, but there is one glaring issue here, and that is that you have to consider the current life cycle of the company. So from my research, I found that usually you want companies that have the DE ratio in the 1.0 to 2.0 range. 1.0 meaning that the debt is exactly equal to the equity, and 2.0 meaning that the debt is basically double the company's value. But here's the problem. In June of 2012, Tesla had a DE ratio of 6.44. In other words, they barely made any money and had around $600 million in debt. But if you think about it, at that time for the company, it made a lot of sense because they were spending a ton of money on research and development, and they were manufacturing a car that was basically built from the ground up for the very first time. So while I think a DE ratio can be helpful, you really need to understand not just the numbers of the company, but exactly where the company is in its growth path and in its life cycle to really see if contextually the DE ratio makes sense. Admittedly, I think that this discussion with AI about investment analysis was one of the best that I've ever had. And personally, I'm not a really big numbers guy. I mean, when I am going to go pick a stock, I like to look at the earnings per share, what they achieved versus what the estimate is. I like to look at the revenue. I like to look at public sentiment. I like to look at their industry, things like that. And I don't know about you, but for me personally, this particular conversation has really changed my investment approach in the future. Definitely there's some things that I'm going to be looking at that is a lot more analytical than I used to do, but I definitely think it's for the best because it just makes good business sense. And as always, don't forget to like and subscribe if you like this video. It really helps us with the YouTube algorithm. And one last thing to remember, this is not financial advice. Investing in the stock market does have some real risk to it. So make sure that you do your research on your own before actually investing any money or talk to an actual expert. Hope you enjoyed, and I'll see you in the next one.